What's up, guys? So yesterday I heard my wife talking with somebody in a room, and I came in and I actually found out that she was talking with ChatGPT. So basically, with your phone, you can talk with ChatGPT instead of writing. So I thought, if I use two phones, let me just make two ChatGPTs talk to each other about investing, and let's see what happens. You see, I can simply click on this symbol here on two phones and I activate the voice AI. Check this out. Alex, what is the best ETF strategy for the next 10 years?
Oh, come on, Jordan. The best ETF strategy for the next 10 years is all about growth. Tech and innovation are where the action is. Think QQQ, VGT, and SMH. These are the ETFs capturing the future, not stuck in the past with dividends.
Oh, Alex, I love the enthusiasm for tech, but let me remind you that while growth is exciting, dividends have a certain charm, especially in volatile markets. You see, cash flow is king, and dividends provide a steady income, even when the market's down. Plus, historical performance shows that dividend aristocrats have outperformed in the long run. So while you're riding that tech wave, I'll be here enjoying the steady, reliable cash flow. What do you think about that?
All right, Jordan, let's talk numbers. In the past 5 years, VGT, the tech ETF, has had an annualized return of around 20%. QQQ, this ETF tracks the NASDAQ 100 and has been a powerhouse, especially in the last decade. With an annualized return around 18% over the past 10 years, it's a solid choice for capturing growth in tech and innovation. SPMO, this is the S&P 500 Momentum ETF, focusing on stocks with strong momentum. It's designed for those looking to capture the upside of trending stocks, offering a different angle compared to traditional growth ETFs. Now, how about you share how your favorite dividend ETFs have performed in the same periods? Also, I'd love to hear how you would set up the perfect portfolio with your top ETFs and their percentages.
Absolutely. Now, when it comes to dividend ETFs, like SCHD, usually offers a dividend yield around 3.5% to 4%, and its strategy focuses on high quality, financially sound companies with a strong track record of paying dividends. It's perfect for investors who want a blend of income and stability. The annualized return over the past 5 years has been around 12 to 13%, which is still quite solid, especially considering the lower volatility. Over the last decade, the performance has been around 10 to 11% annually, which is quite respectable for a value-oriented strategy. Next, we have a VIG, which focuses on dividend growth companies, those that have consistently increased their dividends over time. The yield's a bit lower, around 2%, but it's great for those who are looking for a growing income stream. Then we have JEPI, which is a bit different because it uses an option strategy to generate income. It sells covered calls, which helps to boost the yield, typically around 7 to 8%, but it does cap the upside potential. It's great for income-focused investors who are okay with a bit of a trade-off in growth. As for the perfect portfolio, I'd say a nice mix would be about 60% in dividend ETFs like SCHD and BYM, and about 40% in some growth-focused ETFs just to catch that tech wave.
Jordan, I'm pretty confident that my approach has delivered better results for long-term growth. My portfolio is split with 40% in foundational ETFs like VTI for broad market exposure, and the other 40% in growth-focused ETFs, QQQ, SPMO, and VGT.
Honestly, it's always fun to see how different strategies play out over time. So one of the key reasons I advocate for international diversification is that no economy stays on top forever. The dollar's dominance is facing challenges. Plus, other economies are growing rapidly, and having exposure to these markets can help hedge against potential U.S. economic slowdowns. So Alex, I'm curious, you seem to have a lot of faith in the American economy. What makes you so confident that it will continue to outperform in the long run?
My confidence in the American economy stems from a few key factors. First, the U.S. has a long history of innovation and entrepreneurship. Second, the U.S. financial markets are highly developed and liquid, providing strong support for businesses and investors. This environment fosters growth and stability. Lastly, while other economies are indeed growing, the U.S. still holds a unique position as a global economic leader, attracting talent and investment from around the world. Take Tesla, for instance. As they innovate in electric vehicles and energy solutions, they're not just a car company. They're reshaping how we think about transportation and energy. That kind of innovation can lead them to become the biggest company in the world. Meta and Nvidia are also major players. Meta is diving deep into the metaverse, changing how we interact online. And Nvidia's advancements in AI and graphics are setting the stage for future tech. On the other hand, while companies like Johnson & Johnson or Coca-Cola have their place, they aren't driving the kind of disruptive innovation we see in tech. What do you think is more important for growing your net worth? Reducing your expenses or increasing your income? and why?
That's a classic question, and the answer is a bit nuanced because both play a crucial role. Reducing expenses is often the easiest way to immediately boost your savings rate, and it can have a significant impact over time because you consistently keep more of what you earn. On the other hand, increasing your income can have a compounding effect, especially if you invest those extra earnings. Ideally, a combination of both is the best approach, but if I had to pick one, I'd say increasing income often has a more substantial long-term impact because there's no real cap to how much you can earn, whereas expenses have a natural limit.
I get where you're coming from. However, I believe that reducing expenses is even more crucial. Here's why. When you focus on cutting expenses, you directly control how much you save and invest. This discipline can lead to more consistent and stable growth, regardless of market fluctuations. Plus, cutting unnecessary costs can free up more capital to invest in growth opportunities.
Hey, Alex, I'd love to shift gears a bit and chat about the tariffs that were imposed this year. I believe they could have a significant long-term impact on the American economy. In general, I think these tariffs may have done more damage than good, mainly because they tend to increase costs for consumers and businesses and can lead to trade tensions. I'm curious to hear your take on this. What do you think about the potential long-term effects?
I totally get your concerns about tariffs. They can indeed lead to increased costs for both consumers and businesses and create a lot of uncertainty in the market. However, some argue that tariffs can be used strategically to protect domestic industries and encourage fair trade. For instance, protecting certain key industries might be crucial for national security or for fostering emerging sectors.
Alex, I had a really interesting encounter yesterday. I was walking down the street and met this older gentleman, and we got to talking about investing. He's a bit disappointed because he felt like he started too late, and it really got me thinking about the importance of compounding. So I thought it would be fun to break down the best investment strategies of different decades of life. In your 20s, it's all about growth and taking on a bit more risk, so tech-focused ETFs and index funds are great. In your 30s, you might want to start diversifying a bit more, maybe include some dividend ETFs to build a passive income. In your 40s, focus on stability, maybe a mix of value stocks and some conservative ETFs. In your 50s and 60s, it's all about preserving capital and generating income. So dividend ETFs and bonds become more important. And of course, managing expenses and income is key at every stage.
I do agree that in your 20s, taking on more risk with tech-focused ETFs and index funds makes sense given the time you have for compounding. However, when it comes to the 40s and beyond, I think there's room to consider maintaining a portion of growth investments. This way, you can continue to benefit from compounding while also preserving capital.
Alex, let's switch gears and talk about Bitcoin and crypto.
There are some reasons why people see value in Bitcoin. Firstly, Bitcoin is often viewed as a hedge against inflation and a way to diversify an investment portfolio. Some investors see it as digital gold because, unlike fiat currencies, Bitcoin has a limited supply of 21 million coins, which can provide a level of scarcity. That said, it's crucial to approach Bitcoin with caution. It's always wise to only invest what you're willing to lose and to have a diversified portfolio.
In my view, cryptocurrencies are speculative assets with no intrinsic value, and I believe they could eventually become worthless. Warren Buffett has been quite vocal about this. He once said, if you told me you own all the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? He emphasizes that Bitcoin doesn't produce anything and lacks tangible value. Additionally, studies have shown that Bitcoin's price is highly volatile and driven more by market sentiment than by fundamental value.
Haha, Jordan, it's been a blast debating with you about investing. Even though I'm sure I'm on the path to becoming filthy rich with my strategies, I'm sorry for you, buddy. If you ever want to get serious about investing, you know where to find me. But hey, at the end of the day, the most important thing is to follow and subscribe to Rick D'Agostino's channel. Trust me, that's where the real investing magic happens.
Well, I appreciate the playful banter, and I'm always up for some investing insights, and definitely check out Rick D'Agostino's channel. Here's to our financial journeys.
I mean, that's cool. I didn't know you could actually talk to ChatGPT. And I think I'm going to do it more often. They were pretty clever. I think they articulated their points and their arguments pretty well. Really liked it. Baby, I think we should talk more with ChatGPTs from now on. See you in the next video. Ciao.